The 36% rule says if your debt eats more than 36% of your income, the bank basically owns you before you do. My boy Stix thought he was balling. New car, new watch DoorDash 3 times a day. Boy was living at 52%. 52? That's not a budget. That's a hostage situation. Bank looked at his application and laughed in Comic Sans. Stix thought the rule didn't apply to him because, I got a good job. Turns out the bank doesn't care about your vibes. It cares about your math. So today I'm breaking down the 36% rule, what it is, how to calculate your number in 10 seconds, and how Stix clawed his way back before his car got repoed mid-Wingstop run. And here's why this one number changes. Everything 36% isn't just a bank rule. It's the line between qualifying for your future and getting silently rejected from it. Miss it, and it's not just a car loan you lose. I'll show you everything it actually controls coming up. Nobody actually tracks their debt-to-income ratio. Not because people are dumb, because nobody taught them to. Most people track their credit score, track their bank balance, maybe track their budget app streak. But the one number that actually decides your future? Ignored. That's exactly where Stix lived. He wasn't checking a ratio. He was checking, I have money in my account right now? That's it. That's the whole system he used. And it gets worse for young earners specifically. Data shows buy now, pay later usage skews, hardest toward younger, lower income borrowers. Multiple loans running quietly in the background all at once. Stix had 2 of those running before he even finished paying off his TV. Here's the trap. Getting approved feels like getting cleared. But approval was never a safety test. It's a can we still make money off you test. Real data on subprime auto borrowers shows people get approved constantly and still fall behind. The bank saying yes doesn't mean you're safe. It means you're profitable. But Stix's real problem wasn't just one bad loan. It was a pattern hiding in plain sight. And once I show you what it's called, you're going to see it in your own spending immediately. The average person isn't juggling one debt. They're carrying around 7 open credit accounts at once. Car note, a couple cards, maybe a personal loan. Each one on its own feels small. $770 for the new car. A little minimum here, a little BNPL payment there. Stix did the exact same thing psychologists have a name for. Mental accounting. He put each bill in its own little mental box. This is just my car. This is just Klarna for the sneakers. This is just the phone plan. Nobody adds the boxes together. That's the actual mistake. Not the debt, the refusal to see it as one combined number. And when Stix finally added every box together for the first time, the number that came out nearly knocked him out of his chair, and I promise, when you do this yourself in a second, yours might too. Here's something wild nobody tells you. Your DTI ratio has 0 direct effect on your credit score. None. Credit reports don't even track income. But don't get comfortable. Lenders check your DTI completely separately, every single time, and it decides your denial rate all on its own. You can have a perfect credit score and still get denied because of this one ratio. Now here's where it got real for Stix. His credit card balance sat right around the national average, the $6,018, and he was only paying the minimum about $132 a month. At that pace, over 7 years to pay it off, and it would have cost him $3,610 in interest just to break even, not to get ahead, just to get back to 0. Now flip that. Same $300 a month, but put it into investing instead of feeding debt. At a normal 7% return over just 3 years, that grows into $11,280. Same amount of money leaving Stix's account either way. One path, he ends up almost $12,000 richer. The other path, he pays the bank $3,600 extra for nothing. That gap, nearly $16,000 apart from the exact same $300, that's the real cost of ignoring this rule, and the fix for it is disgustingly simple. Let me show you the actual number Stix needed to hit. Here's the real formula, no fluff. Add up every single monthly debt payment, car, cards, loans, everything, divide by your gross income before taxes, multiply by 100, that's your DTI. Lenders want that under 36%. That's your back-end ratio. There's also a front-end ratio, just housing, which should stay under 28%. But here's the twist that made me mad researching this. 36% isn't even the real ceiling anymore. FHA loans allow up to 43% back-end. Freddie Mac's automated system can stretch approval up to 50% for strong profiles. And with the right compensating factors, some systems go almost to 57%. That's not a safety net. That's the bank betting they can still profit off you even while you're drowning. 36% was never really their limit. It was supposed to be yours. Stix, roughly $3,200 a month, debt eating 52% of it. Denied for an apartment. Not broke. Overleveraged. Now compare that to someone making even less, say $2,600 a month, but sitting at a clean 22% ratio. Same income tier as a lot of y'all watching right now, but because the ratio's controlled, they qualify for better rates and still have room left over to invest. Then there's the good job guy, making $500 a month, almost double what Stix makes, but stuck at a 41% ratio. Still denied for a mortgage pre-approval. Higher income didn't save him. Ratio did the damage either way. Here's what banks really don't want you to think too hard about. They make more money off people who only pay minimums, called revolvers, through sustained interest and fees, compared to people who just pay it off. It's not a mistake in the system. It is the system. This isn't a theory. The CFPB fined Wells Fargo $3.7 billion for illegal practices across auto loans, mortgages, and deposit accounts, including wrongful repossessions. Staying just under 36% forever, barely surviving? That's the bank's dream customer. Stix didn't fix his life by getting a raise. He fixed it by restructuring his ratio. Your income doesn't need to change for your life to change. Your 36% does. Go calculate your number this week, total debt divided by gross income. If it's above 36%, that's not a character flaw. That's just math, and math can be fixed. Drop your number in the comments. Let's see who's actually under 36%.